The stability of the U.S. banking sector has been a subject of significant scrutiny, particularly in the aftermath of the 2008 financial crisis. Despite regulatory reforms aimed at bolstering resilience, there are persistent concerns about the potential for bank failures. This video delves into the key factors contributing to the vulnerability of U.S. banks and the challenges they face in maintaining financial stability. Number 5. Economic downturns. The stability of U.S. banks is intricately tied to the health of the economy, and one of the foremost risks they face is the looming specter of economic downturns. These downturns, characterized by recessions or financial turmoil, pose a significant threat to banks' operations. When borrowers face financial hardship during such periods, they may struggle to repay their loans, resulting in a surge of non-performing assets on banks' balance sheets. This increase in non-performing loans can ripple through the banking sector, weakening banks' financial positions and eroding their capital reserves. With diminished capital reserves, banks may find themselves ill-equipped to weather the storm of an economic downturn, exacerbating the strain on their operations and potentially leading to systemic issues within the financial system. Given the cyclical nature of the economy, downturns are an inevitable part of the economic landscape. As such, it is imperative for banks to proactively prepare for adverse economic conditions. This preparation may involve stress testing their balance sheets, fortifying their capital buffers, and implementing risk management strategies to mitigate the impact of economic shocks. Furthermore, banks must remain vigilant and adaptable in their approach to risk management, recognizing that the landscape of economic risks is dynamic and ever-evolving. By maintaining a robust risk management framework and a prudent approach to lending and investment activities, banks can enhance their resilience to economic downturns and fulfill their crucial role in supporting the broader economy. Number 4. Exposure to risky assets. U.S. banks face another significant risk in their exposure to risky assets, encompassing a variety of investments ranging from subprime mortgages to high-yield bonds and complex financial instruments. Despite regulatory reforms aimed at bolstering risk management practices and improving transparency in asset valuation, the inherent complexity and opacity of some of these assets pose ongoing challenges. The allure of higher returns often accompanies investments in risky assets, enticing banks to seek out these opportunities to bolster their profitability. However, the potential for substantial losses looms large, particularly if banks underestimate the risks associated with these assets. A miscalculation in risk assessment can swiftly translate into significant financial setbacks, eroding banks' solvency and destabilizing their operations. While regulatory measures have sought to mitigate these risks by imposing stricter capital requirements and enhancing oversight, the possibility of unforeseen vulnerabilities persists. The interconnectedness of financial markets and the rapid pace of innovation in financial products further complicate risk management efforts, necessitating continual vigilance and adaptation on the part of banks and regulatory authorities alike. In navigating this landscape, banks must prioritize robust risk management frameworks that incorporate rigorous stress testing, scenario analysis, and ongoing monitoring of their asset portfolios. By maintaining a disciplined approach to risk assessment and exercising prudence in their investment decisions, banks can mitigate the likelihood of adverse outcomes and safeguard their financial stability in an environment fraught with uncertainties. Number 3. Leverage and capital adequacy. The level of leverage within banks serves as a crucial gauge of their resilience to financial shocks, with highly leveraged institutions being particularly vulnerable to adverse events. Leverage, essentially the ratio of a bank's assets to its equity capital, magnifies both gains and losses. While higher leverage can amplify returns in favorable market conditions, it also exposes banks to heightened risks during times of economic turmoil. A key determinant of a bank's ability to weather financial shocks is the size of its capital reserves. Capital serves as a buffer against unexpected losses, providing a cushion that allows banks to absorb hits to their balance sheets without jeopardizing their solvency. Adequate capital reserves are thus essential for maintaining confidence in the banking system and ensuring the stability of financial markets. However, if banks operate with insufficient capital buffers relative to their risk exposure, they face heightened vulnerability to adverse developments. During periods of financial stress, such as market downturns or credit crises, the inadequacy of capital reserves can leave banks ill-equipped to absorb losses, triggering a cascade of deleveraging efforts or, in extreme cases, outright failures. Regulatory authorities recognize the critical importance of capital adequacy in safeguarding financial stability and have implemented measures to enforce minimum capital requirements for banks. These regulations, such as Basel III, aim to enhance the resilience of the banking sector by mandating higher capital ratios and stricter risk-weighted asset calculations. Nevertheless, the effectiveness of regulatory safeguards hinges on their enforcement and the willingness of banks to comply with prudent capital management practices. Moreover, the evolving nature of financial markets necessitates continual reassessment of capital adequacy standards to address emerging risks and vulnerabilities. Number 2. Interest rate risks. Fluctuations in interest rates represent a substantial risk factor for banks, impacting both their profitability and the quality of their assets. For banks heavily reliant on interest income, declines in interest rates present a particular challenge. When interest rates fall, banks' net interest margins, the difference between the interest earned on loans and the interest paid on deposits, tend to shrink. This compression in margins can squeeze banks' profitability as they earn less income from their lending activities. Conversely, rising interest rates can also pose risks to banks, albeit through a different mechanism. As interest rates climb, borrowers with variable rate loans face higher interest payments, which constrain their ability to repay debts. This, in turn, may lead to an uptick in loan defaults, particularly among borrowers with stretched financial capacities. For banks holding such loans in their portfolios, a surge in defaults can result in deteriorating asset quality and increased credit risk. Given the inherent volatility of interest rates, effective interest rate risk management is paramount for banks to navigate these fluctuations and mitigate potential losses. This entails employing various strategies to hedge against interest rate movements and minimize the adverse impact on their financial performance. One common approach to managing interest rate risk involves diversifying banks' sources of income beyond traditional lending activities. By expanding into non-interest income streams, such as fee-based services or investment banking, banks can reduce their dependence on interest rate-sensitive revenue sources and enhance their overall resilience to interest rate fluctuations. Additionally, banks utilize derivative instruments, such as interest rate swaps or options, to hedge against adverse movements in interest rates. These financial instruments enable banks to lock in favorable interest rate terms or protect against potential losses arising from interest rate volatility, thereby safeguarding their financial positions. Furthermore, prudent balance sheet management practices, such as maintaining a balanced mix of fixed rate and variable rate assets and liabilities, can help banks mitigate the impact of interest rate fluctuations. By aligning the maturity profiles of their assets and liabilities and closely monitoring their interest rate sensitivity, banks can better withstand shifts in the interest rate environment and preserve their profitability. Number 1. Operational risks. Banks face a myriad of operational risks, ranging from cyber threats to technological failures and operational errors, all of which can have profound implications for their stability and reputation. Among these risks, cyber attacks have become increasingly prominent, fueled by the rapid digitization of financial services and the growing sophistication of malicious actors. The threat landscape in cyberspace is constantly evolving, with cybercriminals employing increasingly sophisticated tactics to exploit vulnerabilities in banks' digital infrastructure. A successful cyber attack can wreak havoc on banking operations, disrupting critical services, compromising sensitive customer data, and causing financial losses or reputational harm. The consequences of a cyber breach extend far beyond financial implications, encompassing a loss of customer trust and confidence in the bank's ability to safeguard their personal and financial information. The fallout from a data breach can erode long-term customer relationships and tarnish the bank's brand image, making it imperative for banks to prioritize robust cybersecurity measures. To combat cyber threats effectively, banks must adopt a multi-layered approach to cybersecurity that encompasses preventive, detective, and responsive measures. This includes implementing robust access controls, encryption protocols, and intrusion detection systems to fortify their digital perimeter against unauthorized access and malicious activities. Furthermore, ongoing cybersecurity training and awareness programs are essential for educating bank staff about emerging threats and best practices for mitigating cyber risks. By fostering a culture of cybersecurity awareness and vigilance, banks can empower their employees to recognize and respond effectively to potential threats, thereby strengthening the overall resilience of their cybersecurity defenses. In addition to proactive cybersecurity measures, banks must also develop comprehensive incident response plans to swiftly contain and mitigate the impact of cyber attacks when they occur. This involves establishing clear protocols for detecting, reporting, and responding to security incidents, as well as coordinating closely with law enforcement agencies and cybersecurity experts to investigate and remediate breaches effectively. Ultimately, robust cybersecurity measures and operational risk management practices are indispensable for safeguarding banks against the growing threat of cyber attacks and ensuring the resilience of the financial system as a whole. By investing in cybersecurity capabilities and fostering a proactive risk management culture, banks can mitigate the risk of operational disruptions and protect the trust and confidence of their customers in an increasingly digital world. Would you like it? Hit the like button and subscribe to our channels for more interesting and informative videos.